Japan's 30-year bond yield just hit 3.91%, the highest level since these bonds were invented in 1999. The US Federal Reserve just intervened to prop up the yen. Think about that for a second. America is spending dollars to support another country's currency. Japan owns $1.2 trillion in US debt. When Japanese bonds start paying more than American bonds, that money comes home. And when $1.2 trillion starts moving, your 401k, your stocks, your real estate, everything gets hit. This isn't a warning anymore. This is happening right now. My name is Alex, and I've spent the last decade tracking sovereign debt markets and central bank policy so you don't have to. I read Bank of Japan reports, Federal Reserve minutes, and Treasury auction data because most people would rather watch paint dry. But when this stuff moves, it moves your money. If you want to understand what's actually happening in markets before CNBC figures it out, make sure to hit that subscribe button and give this video a thumbs up if it helps you see what's coming. Before we dive in, I want to know, are you buying this dip, holding, or getting out? I need to see where this audience stands. Drop it in the comments. Here's what you need to understand. For 30 years, Japan has been the world's piggy bank. Interest rates at zero, bond yields at zero. So investors borrowed yen for free, converted it to dollars, and bought US assets yielding 4 or 5%. Free money. The greatest arbitrage trade in financial history. Trillions of dollars flowing from Tokyo to New York every single year. That trade just broke. And when the biggest money flow on the planet reverses direction, nothing stays the same. But here's the thing most people are missing. This isn't just about Japan. This is about the foundation of American debt financing. Europe holds $8 trillion in US bonds and equities. Japan holds $1.2 trillion. China's been selling for years. The United States runs a $2 trillion annual deficit. That money comes from somewhere. It comes from foreign investors buying treasury bonds. When those investors have better options at home, they stop buying. And when the biggest buyers step away from an auction, the price drops. In bonds, when prices drop, yields spike. Higher yields mean higher borrowing costs. Higher borrowing costs mean everything. Mortgages, car loans, corporate debt, government spending. Everything gets more expensive. What I'm about to show you next is the thing that took me years to piece together, because nobody talks about how these dominoes actually fall. Let me take you back to January 20th, 2026. Tokyo. 4 a.m. local time. The Japanese bond market opens. Within the first hour of trading, the 30-year Japanese government bond yield explodes by 30 basis points. By the end of the day, it's up 42 basis points. The 40-year yield hits 4.24%, the first time any Japanese sovereign bond has breached 4% in over 3 decades. Bloomberg terminals are lighting up red across every trading floor in the world. What triggered this? Two things happened simultaneously. Prime Minister Sanae Takaichi, who had been in office for exactly 3 months, called for massive government spending increases with simultaneous tax cuts. She wants to pause the 8% consumption tax on food purchases. She announced snap elections to get public support for this plan. For a country with a debt-to-GDP ratio of 260%, the worst in the world, more than double America's, the market's reaction was instant and merciless. Here's what that number means. Japan's government debt is 2.6 times the size of their entire economy. Imagine if your mortgage was 2.6 times your annual salary. Now imagine your banker watching you announce you're going to quit your job, spend more money, and ask for a bigger loan. That's what happened. Bond investors sold. Yields spiked. But there's a second element here that makes this way worse. The Bank of Japan, Japan's version of the Federal Reserve, has been quietly shifting policy for months. Last month, they raised their key interest rate to 0.75%. That's a 30-year high. I know that sounds insane to American ears. 0.75% is a 30-year high. But in Japan, that's a seismic shift. For 3 decades, the Bank of Japan has been the biggest buyer of Japanese government bonds. They print yen and buy bonds to suppress yields and keep borrowing costs at zero. It's called yield curve control. They controlled the curve. Past tense. According to Oanda, the Bank of Japan has slashed 21 trillion yen from its balance sheet. They've been cutting bond purchases by 400 billion yen every single quarter. The Bank of Japan is no longer the whale in the Japanese government bond market. They're not gobbling up debt to suppress yields anymore. They stepped back. And the moment they stepped back, the market showed the real price. That real price is almost 4% on the 40-year bond. Now let me connect this to your portfolio, because this is where it gets personal. Japan is the largest foreign holder of US government debt. Japanese entities held about $1.2 trillion in US Treasury securities as of November 2025, according to CNBC. That's 12.4% of all foreign investment in US privately held federal debt. For 30 years, Japanese investors have been particularly aggressive buyers of US debt because American interest rates were higher than Japanese rates. Borrow at zero in Japan. Buy treasuries at 3 or 4% in America, pocket the difference. That's the carry trade. But now Japanese bonds are yielding 3.7%, 3.9%, over 4% on the long end. US Treasuries are yielding 4.5% on the 10-year, about 4.8% on the 30-year. You're talking about a 50 to 100 basis point difference. After you factor in currency risk, the risk that the yen strengthens and wipes out your gain when you convert back, that razor-thin margin disappears. Why would a Japanese pension fund take currency risk for 0.1% extra yield? They wouldn't, and they're not. Here's the quote from CNBC that should terrify you. Now that their yields are going up, Japanese bond investors may be more likely to stay home and invest in their own bonds rather than in the US, so that could put some upward pressure on US rates. Upward pressure. That's the polite way of saying Japanese money is coming home. And when $1.2 trillion comes home, it has to come from somewhere. It comes from selling US Treasuries. If you've made it this far, you're already ahead of 90% of people. But don't stop now, because the next part is where everything clicks. The carry trade isn't just Japanese institutions. It's hedge funds, global macro funds, sovereign wealth funds, private investors. Anyone with access to cheap yen borrowed it and deployed it into higher yielding assets around the world. US stocks, US bonds, real estate, emerging market debt, crypto. The yen carry trade is estimated to be worth trillions of dollars in total global exposure. And it's all predicated on one thing: Japanese rates staying near zero forever. That assumption just broke. According to Wolf Street, quote, "The carry trade is the hot money. It can change direction at any time. Investors can sell their foreign currency assets, exchange the dollars back into yen, and pay off their yen debt, suddenly reversing capital flows." End quote. Let me put that in simple terms. When the carry trade unwinds, here's what happens. Step 1, sell US assets. Stocks, bonds, real estate, whatever was bought with borrowed yen gets sold. Step 2, convert dollars back to yen. That strengthens the yen and weakens the dollar. Step 3, pay off the yen debt. This all happens fast. This isn't a slow rotation, this is a scramble. We've seen this before. August 2024, the Bank of Japan raised rates by a tiny amount, just 15 basis points. The market freaked out. Bitcoin dropped 23% in days. The Nasdaq dropped 10%, the S&P dropped 8%. That was a preview. A tiny rate hike caused massive volatility because it threatened the carry trade. Now we're talking about Japanese yields spiking 40+ basis points in 2 days, breaching 4% for the first time in 3 decades. This is exponentially bigger. And here's the truly dangerous part. US Treasury Secretary Scott Bessent was asked about this at the World Economic Forum in Davos. His response, according to Euronews, "It's very difficult to disaggregate the market reaction from what's going on endogenously in Japan." Translation: we can't control this. He also said he's been in touch with Japan and they will begin saying the things that will calm markets down. Saying, not doing, saying. When a Treasury Secretary's plan is, "we'll say some calming words," you know the situation is out of control. Now let me tie all of this together, because when you see how these pieces connect, everything changes. There's a concept in investing called the 60-40 portfolio. 60% stocks, 40% bonds. The idea is that when stocks go down, bonds go up, and your portfolio stays balanced. It's been the foundation of retirement planning for 50 years. That relationship is called negative correlation. Stocks and bonds move in opposite directions because when investors get scared, they sell stocks and buy bonds. Flight to safety. But that relationship only works when investors trust the government issuing the bonds. When government creditworthiness comes into question, stocks and bonds fall together. Ken Griffin, the founder of Citadel, one of the biggest hedge funds in the world, said recently that bonds are losing a substantial part of what makes them so special in constructing a portfolio. He's talking about this exact dynamic. Your 60-40 portfolio assumes bonds are the safe asset. But when bond yields are spiking not because of economic strength, But because investors are questioning the government's ability to pay its debts, bonds stop being safe. You get a correlation breakdown. Stocks down, bonds down, real estate down, everything down simultaneously. No hedge, no protection. That's the nightmare scenario for retirees, pension funds, endowments, anyone who built their financial plan on the assumption that bonds are the safe part of the portfolio. And it's not just Japan. Europe holds $8 trillion in US bonds and equities, about twice as much as the rest of the world combined, according to Deutsche Bank. George Saravelos, Deutsche Bank's head of research, said, "The US has one key weakness. It relies on others to pay its bills via large external deficits. Europe, on the other hand, is America's largest lender." Now ask yourself this question. Europe is facing the largest security crisis since World War II. Russia on the border, Ukraine war dragging on, the United States pulling back from NATO commitments. Europe needs to increase defense spending by hundreds of billions of dollars. Where does that money come from? They can raise taxes, politically difficult. They can issue more debt, but they're already heavily indebted. Or they can sell assets, like $8 trillion in US holdings. The prospective unwinding of the Japanese carry trade, according to the American Enterprise Institute, comes at an awkward time for the United States. At the very time when Trump's large tax cuts have increased the US government's budget deficit to an annual rate of around $2 trillion. Let me make this clear. The United States needs to borrow $2 trillion this year. Japan is pulling back. Europe might pull back. China's already selling. Who's buying? The answer is American investors at much higher yields. When foreign buyers step away, the Treasury has to raise yields high enough to attract domestic buyers. That's already happening. The 10-year Treasury yield is at roughly 2.3%, the highest in more than 30 years, according to Hoka News. Wait, that doesn't sound right. Let me correct that. The 10-year Japanese bond is at 2.3%. US 10-year yields are above 4.5% right now. That's the critical level. When the 10-year breaks 4.5% decisively, that's a danger signal. When the 30-year breaks 5%, that's a red alert. The rout that Japanese bonds experienced also forced violent repricing in other markets throughout the following days, causing US Treasury yields to jump, according to Euronews. This is correlation. This is contagion. What happens in Tokyo doesn't stay in Tokyo. Now here's the part that actually matters for your money. What should you be watching? 3 things. First, the US 10-year Treasury yield. If it goes above 4.5% and stays there, that's your danger signal. The 30-year yield above 5% is a red alert. Those levels mean the market is demanding much higher compensation for the risk of holding US debt long term. Second, the dollar-yen exchange rate. If the yen is strengthening, if the exchange rate is moving from 150 yen per dollar down toward 130, that means yen carry trades are unwinding. Money is flowing back to Japan. That creates selling pressure on US assets. Third, watch credit spreads. That's the difference between corporate bond yields and treasury yields. When credit spreads widen, it means investors are getting nervous about corporate debt. In a carry trade unwind, highly leveraged companies get hit first. Now let's talk about what to do. I'm not a financial advisor, but I can tell you what smart investors are positioning for. Michael Purvis, a macro strategist who's been tracking this closely, recommends increasing allocation to gold and silver. Precious metals tend to hold value when confidence in paper assets erodes. Not because gold pays dividends or generates income, but because it's no one's liability. It's not a promise. It's an asset. Quality large-cap tech. Microsoft, Apple, Meta, Google. These companies have fortress balance sheets, generate massive free cash flow, and aren't dependent on cheap debt. They can weather a bond market storm better than most. Consumer staples. Coca-Cola, Procter & Gamble, Walmart. When volatility spikes, people still buy toothpaste and groceries. Defensive positioning. Energy. Exxon, Chevron. Energy demand is inelastic in the short term. People need gas and heating oil regardless of what bond yields are doing. What to avoid? Regional banks and financials. Banks hold bonds. When bond prices fall, banks take losses. We saw this with Silicon Valley Bank in 2023. A bond portfolio that was supposed to be safe became a source of massive losses when yields spiked. High debt zombie companies. Any company that's been surviving on cheap debt and rolling over loans at low rates is in serious trouble when rates spike. If they have to refinance at 7 or 8% instead of 3%, the math stops working. Speculative tech. Unprofitable growth companies that need continuous access to cheap capital are going to get crushed in a high-rate environment. Discretionary consumer stocks. When people are worried about their portfolios and their borrowing costs are going up, they stop buying new cars, new furniture, luxury goods. Discretionary spending drops fast. Here's the psychological shift you need to understand. For 15 years, since the financial crisis in 2008, the dominant investment strategy has been buy the dip. Every time markets fell, the Federal Reserve cut rates, printed money, and bailed everyone out. Stocks recovered, bonds recovered, real estate recovered. Buy the dip worked because central banks had your back. That era is over. Central banks are tapped out. The Bank of Japan is trying to normalize policy after 30 years of zero rates. The Federal Reserve has been raising rates and is now caught between inflation and financial stability. They can't print their way out of this one without destroying the currency. The safety net is gone. We're now in an environment where you have to be selective. You have to own assets that generate real cash flow, that have pricing power, that can survive in a world where borrowing costs are higher and liquidity is tighter. The free money era, borrow at zero, buy anything, watch it go up. That's done. The real magic here isn't predicting exactly when the bond market cracks or exactly which week the carry trade fully unwinds. The magic is understanding that the structure has changed, the foundation shifted, and when the foundation shifts, the buildings built on that foundation become unstable. Japan's bond yield hitting 4% is the canary in the coal mine. It's the warning signal that the entire global debt structure, the system where governments borrow unlimited amounts at artificially low rates because central banks manipulate markets, that system is reaching its limit. When a country with a 260% debt to GDP ratio can't keep yields suppressed anymore, what does that tell you about every other over-indebted nation? According to Trading Economics, as of January 27, 2026, the yield on Japan's 30-year bond is at 3.67%. It spiked, it pulled back slightly, but it's still near 30-year highs. This isn't a one-day freakout. This is sustained pressure. The question isn't if this affects you. The question is how much. If you're 100% in index funds, S&P 500, total stock market, you're going to feel this. If you're in a target date retirement fund that's 60% stocks and 40% bonds, you're going to feel this even more because both sides of your portfolio are going to move down together. If you own real estate with a variable rate mortgage or a HELOC, you're going to feel this when your monthly payment jumps. If you're planning to buy a house in the next year, you're going to feel this when mortgage rates spike above 7% again. This is not abstract. This is not theoretical. This is happening right now in real time, and it's going to accelerate. Here's what I need you to understand on a deeper level. The financial system is built on confidence. Confidence that governments will pay their debts. Confidence that central banks can control inflation without breaking markets. Confidence that the dollar remains the global reserve currency. When that confidence cracks, not disappears, just cracks, capital flows reverse. Money that was flowing into US assets starts flowing out. When money flows out, prices fall. Your stock portfolio, your bond portfolio, your real estate holdings, all of it reprices lower. The people who survive this are the ones who see it coming and position accordingly. The people who get destroyed are the ones who keep believing the old rules still apply. Buy the dip. Diversification protects you. Bonds are safe. The Fed has your back. Those rules worked for 15 years. They don't work anymore. So what's the move? Get liquid. Get defensive. Own assets that generate cash. Own assets that hold value when paper promises get questioned. Gold, silver, quality equities with real earnings, energy, staples. Avoid leverage. Avoid speculation. Avoid anything that requires cheap debt to survive. And watch those three signals. 10-year yield above 4.5. 30-year yield above 5. Dollar-yen below 140. When all three hit, that's your confirmation that the carry trade unwind is in full swing. At that point, volatility is going to spike across every asset class. One more thing. I want to know what financial topic is keeping you up at night right now. What's happening in markets or the economy that you can't find a straight answer on? Drop it in the comments. That's what this channel is for. Cutting through the noise and explaining what actually matters. 10 years from now, you're going to look back at this moment. You're going to remember where you were when Japanese bond yields broke 4%. You're going to remember what you did next. Did you ignore it? Did you assume it would blow over? Or did you adjust, protect your portfolio, and position yourself for what was coming? Your future self is counting on the decisions you make right now. The bond market just told you something important. The only question is whether you're listening.